My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money here. My job is not just to entertain, but to educate. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Make or break. That's how I always feel about this week coming up, where we hear from Alphabet, Meta, Apple, Microsoft, and Amazon. These tech titans all report at the same time because they're trying to give me a heart attack. Only NVIDIA is missing. Thank you, Jensen. Oh, and let's throw in that we have the non-farm payroll report on Friday, where, you know what we want? We actually want a weak hiring number so the Fed can keep cutting rates. Put it all together, and today's action feels kind of meaningless. Even as the Dow lost 260 points, S&P dipped 0.03%, but the Nasdaq gained 0.56%. I mean, to me, it's just kind of staging for what's going to be a huge, huge week that you must watch us. So let's go straight to the game plan for next week. Monday begins Ford Motor, and I very much want to see them have a clean quarter with no warranty issues and not too much loss on electric vehicles, although that may be too much to ask for. Tuesday, we're going to hear from McDonald's. Now, listen to this. We're probably going to get a full airing of the E. coli situation, which has taken a turn for the worse. CDC saying the outbreak has grown. There are 26 new cases. It's too soon to tell how much damage is being done to the brand of McDonald's. Now, look, I think there'll be a short-term overhang. But remember, McDonald's has been on fire ever since they announced that $5 meal deal when a lot of customers really got more excited. Wall Street can't stay away from the stock. We'll know whether there's going to be a moth to the flame situation or whether it's just going to be solid for the rest of the year. The cruise stocks have become, they've probably been the strongest, most reliable names in the entire consumer space. Royal Caribbean is the number one. I'm predicting a large beat and raise when they report on Tuesday. They keep doing that. By the way, I also think that both Reddit and PayPal will do terrifically. All three are hot stocks. I bet all three will remain that way. After the close, the playoff attitude shrouds the reports. It's tense. You need to be ready for the ecstasy of a clean beat. Or, I'll tell you, it might be the agony of a forecast cut. We're starting to see a few of those this week. First, we have from Alphabet. Now, the stock's been all over the map, but rarely in a good way. Now, we've trimmed our position in what you know is Google for the Charitable Trust because it's hard to trust. Too often, Alphabet fails to impress. I think it's a great company, okay, but it's not a great stock because management often seems indifferent to the things that investors and analysts want to hear. They really need to talk also about breaking out Waymo somehow. They've lost a ton of money, and they don't have enough cars. Not enough cars on the road. And that has to change in order for them to show that they are not niche, which is pretty much how Elon Musk described them in his Tesla conference call. Hey, you want some controversy? Just say you like AMD, as we do for the Charitable Trust. We know that AI is big, big, big. Big enough for more than just one chip maker. AMD won't catch NVIDIA, but it will do enough to take chunks of the business. Plus, it has tremendous PC exposure right into the teeth of a big PC refresh cycle. We're buying more AMD into any weakness for the trust because this is a long-term terrific story. Chipotle reports, too. Without Brian Nichols, who's moved in to try to fix Starbucks, I think Chipotle will be fine. I don't know if it can break out from the 50s. The stock feels trapped, doesn't it? But the announcement of a permanent CEO could work some wonders here. Now, Wednesday morning, Eli Lilly, one of our best picks for the Charitable Trust, okay? And that's had quite a run thanks to the GLP-1 weight loss drugs. This morning, Stifel, brokerage house, put out a note that talks about the impact of these drugs on the food stocks. Unlike pretty much everyone else, all the analysts and the people in the food industry, these guys say it's going to impact the food companies negatively. Well, that means it's going to impact Lilly positively. When we walked around the floating platform in the Gulf of Mexico yesterday, I peeked at all the nameplates on every machine I saw. And the predominant one, it was Caterpillar, which makes solar turbines, we call them turbines, that would power a great deal of activity on the platform. Chevron CEO Mike Wirth reminded me that Jim Umpleby, the CEO of Caterpillar, actually came from that division. Cat reports in the morning, I think it could be very, very strong. I just don't know if it'll be strong enough to move what has been an incredibly hot stock. If you take a look at that run-up, I wouldn't be surprised if it actually gave up some of that. It's up 30% for the year. After the close, we got two stalwarts of the Mag 7. We got Meta Platforms and Microsoft. Meta reported a stellar quarter last time. I think they can do it again because the whole ad market seems to be going their way. But Microsoft, let's talk about how Copilot may not be as strong as we thought. Somehow they have to put that story to rest, or it's going to dog the stock until they come up with a new narrative. Here's one that makes a big splash every time. It's called Booking Holdings. Yes, the old Priceline. It's been ages since this company didn't have a smashing quarter. Then everybody speculates about whether the consumer is still traveling. At the exact same time, DoorDash reports, again, I think it'll be very strong and should shed some more light on the consumer. Then all sorts of traders will start to extrapolate from the results to the Fed's next move. Time-honored dog bites man stuff. Don't let it get to you. Thursday can top Wednesday because that's when Apple and Amazon report. Now, we've heard lots of negative chatter about the iPhone 16 to launch. I think that the chatter's right. I think people will rush to sell. I say hold on. We've seen this movie before. Apple's had suboptimal launches before, and the best strategy has been to own it, don't trade it. I bet it'll be right again. Now, I want you to gird yourself for a weak number. Everyone's expecting a weak number. When you get a weak number, guess what? The stock goes down, and then you have to buy. Be ready to do so. Amazon's hard. People truly disliked the last quarter, and the stock was hammered mercilessly because the company somehow got linked with echoes of a weak consumer. I don't buy it. I think Amazon's doing very well. Of course, a few weeks later, from when they reported that so-called bad quarter, the stock was right back to where it was trading before it reported the quarter, and then it went higher still. If you don't own any, again, I don't want you to buy it ahead. You buy it after. We got two drug stocks on Thursday, too. We got Merck and Bristol Myers. This group has been castigated as the wrong place to be when the Fed cutting rates. The hedge fund playbook says that. I think both stocks, though, are too low. But I also know that if you get a weak employment number on Friday, Merck and Bristol Myers will be two stocks that you should not have bought. So put that in a little retrospect. Speaking of employment, on the first Friday of the month, we get the non-farm payroll report. I can't stress how important this number is. We have an upcoming Fed meeting, and we're now seeing cyclicals really miss their numbers because of higher interest rates. A lot of them are rolling over. But if employment stays as strong as it's been, then we're going to hear that there will be no November rate cut. We'll also accept the fact that the 10-year yield is going to be at 4.5 by then after floating at 4.2. I'm trying to notice there's a theme here. I'm trying to steal you because I know there are people who want to sell. But this is a Fed rate cut cycle. You want to buy. I told you this week was going to have a playoff atmosphere where you can see the stakes are incredibly high. Finally, we hear from the biggest oil companies, Chevron and Exxon. We just got back from a Chevron platform in the Gulf of Mexico. I got to be impressed, by the way. Chevron's been able to return a huge amount of capital in dividends and buybacks. Yet, you know what? It's still the laggard. It's the worst performer in the group. If not for that battle over Exxon with Exxon or for the Hess acquisition, I think the stock would be quite a bit higher because of its great conventional flow. Exxon doesn't have the earnings power that Chevron has, but it's got a lot more love right now. I think people should switch their allegiance and like Chevron. There's Mike Wirth, knows what he's doing. Bottom line, huge week, huge opportunity. Just please remember the first move's been wrong, I'd say probably maybe almost a half the time since this earnings season began. Wait to process the numbers. Listen to the conference call before you pull the trigger. And if you don't want to do the homework yourself, well, guess what? The CNBC Investing Club's happy to do the heavy lifting for you. Bill in Massachusetts. Bill.
Jimbo, Boston
yo.
Bill here, giving you a gigantic quad booyah, my friend.
Holy cow, that's a serious booyah. I mean, really one of the more serious ones this week. How can I help you?
Listen, Jim, I got some Home Depot, and I'm a little bit concerned as far as is the Fed rate going to go down? It seems to be very volatile right now. Also, I'd like to know, will any tariffs affect the equipment at Home Depot? Cost?
Well, I'll tell you. What's really interesting about Home Depot is since the Fed rate cut cycle, this has been trading with the 10-year. That's how the stock could go from 420 just 10 days ago down to 398. You know what that says? It's being conditioned to be able to buy for the next move, and I'm not worried about the problem that you mentioned. I do feel that Home Depot is the right stock to buy into a Fed rate cut cycle. Big busy weeks like this one are coming up. Please remember to slow down, process the numbers. If you can listen to the conference calls, it's even better. Or, of course, just join the CNBC Investing Club where we'll listen to them around the clock on Mad Money tonight. UPS might be finally turning things around. Wouldn't that be great with that dividend and everything? Can the company keep delivering on results after this nice quarter? I'm digging into yesterday's earnings. Then Deckers Outdoor was the second best performer in the S&P today. I'm taking a closer look at how the company's been putting its best foot forward when it reported good numbers, raised much of its outlook. So why are investors sending the stock out the pasture? I'm hearing from the CEO of Tractor Supply. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Weeks ago, I told you I was a little worried about United Parcel Service. They got into the habit of missing expectations. FedEx had just reported a weak quarter in September. So I was surprised as anyone when UPS delivered a better than expected quarter yesterday, one that sent the stock up more than 5% in a single session. While out in the middle of the Gulf of Mexico, I made a note to dig into that quarter, figure out how the heck UPS turned things around, and more important, could the turn be sustainable? Why don't we start with the numbers? UPS posted higher than expected revenue, up 5.6% year over year. The first positive revenue growth number in 8 quarters. Hey, there's a good one. And the strength here was broad-based. Domestic up 5.8%, international up 3.4%, supply chain solutions up 8%. Of course, the big problem for UPS has been its inability to get its costs under control. That's the sticking point, in part because they had to sign an extremely generous contract with the Teamsters Union last year. Teamsters played tough. This time, though, the company had excellent margins, which allowed them to earn $1.76 per share. Wall Street was only looking for $1.64. That's big. The earnings were up 12% year over year. Again, pretty darn good. Now, UPS did cut its full-year revenue forecast from $93 billion down to $91.1 billion, which is a good bit less than what the analysts were looking for. But the stock didn't get dinged for it. I thought it would. But there were a couple reasons why it didn't get dinged. First, management had a legitimate explanation. In the third quarter, UPS completed the sale of Coyote Logistics. That was their truckload brokerage business, so they had to take those numbers out of their guidance. Well, okay. Second, and more important, UPS also raised its full-year operating margin outlook, albeit only slightly, from the previous 9.4% to a new goal of 9.6%. Again, that is, though, a big deal, because profitability is what these guys have been struggling with. On the conference call last night, CEO Carol Tomé said, and I'm going to quote, "The macro environment was slightly worse than expected," end quote, with slower online sales in the U.S. and weaker than expected manufacturing activity both in the U.S. and international, which weighed on volumes. Still, Tomé explained that UPS overcame that by, quote, "leaning into the parts of the market that value their end-to-end network," end quote, and through ongoing productivity initiatives, which helped on the cost front. For the company's largest segment, the U.S. domestic business, management noted the volumes are flowing back into their network. So now UPS is chasing revenue quality, not revenue. They want the best paying businesses that they can get their hands on. And if certain kinds of customers are willing to pay a higher price, UPS is willing to charge a higher price. As a result, revenue per piece grew sequentially during the quarter, and Tomé expects that trend to continue. Think of it like this. Back when volumes were limited, something UPS was plagued by for several quarters, they were in a, let's say, beggars can't be choosers situation. They couldn't afford to turn down less profitable business, and they couldn't afford to demand higher prices. But now that volumes have turned positive again, something that happened in the second quarter and picked up during the third quarter, UPS has a lot more bargaining power. Very positive for the core domestic package delivery operation. For the international business, management touted service improvements with expanded residential Saturday delivery in the company's 8 largest markets in Europe, plus faster deliveries to over 35 countries across Asia, Africa, and the Middle East. All regions grew revenue year over year. Revenue per piece was up 2.5%. Finally, United Parcel Supply Chain Solutions division had a noisy quarter. They got some benefits from their acquisition of MNX Global Logistics last November, but the sale of Coyote Logistics also wasn't in the estimates. And that's put downward pressure on the numbers. Very confusing, by the way. Meanwhile, a new contract for U.S. Post Office air cargo began this quarter, which helped revenue, but also hurt profitability for the segment, as UPS is reconfiguring its air network to handle that business. Putting all of that aside, though, the supply chain solutions business saw healthy growth in air and ocean forwarding thanks to the brief port strike. But you know what? That's another one-off. Got to be careful there. Now, looking forward, we didn't get much out of management, especially when it comes to their outlook for 2025, even as the analysts tried very hard to needle something out of them on the call. At one point, after the fourth different analysts asked some version of, hey, how does 2025 look? Tomei just said simply, quote, let us get through the fourth quarter, and then we'll give you our outlook for 2025, end quote. By the way, when it comes to the crucial holiday season, Tomei sounded confident that UPS is well prepared for this moment. Because there are only 17 shipping days between Black Friday and Christmas Eve this year, she thinks UPS has what it takes to move the right amount of volume in the shortest amount of time. Always a big worry for UPS. Overall, this was a legitimately strong quarter for the company, strong enough to overcome the mixed updates to the full-year forecast and the lack of any detail whatsoever on 2025 and beyond. But at the end of the day, I think there's a much simpler explanation for why this stock caught fire yesterday. Right now, UPS is all about trust. They've missed the numbers so many times that Wall Street simply doesn't believe management anymore. This March, the company held an investor day where they introduced some long-term financial targets through 2026. Those targets look great, but the stock sold off in response because the analysts don't believe the numbers are achievable. Then in July, UPS reported a stinker of a quarter, but said it expects the business to turn around in the second half. Again, though, nobody was willing to give this company the benefit of the doubt. UPS had become a show-me stock, and yesterday they finally showed us when the company reported a strong quarter. It proved that management was right when they predicted a turnaround in the second half. For me, that's the biggest takeaway from the quarter. Of course, UPS still has a lot to prove. For starters, they need to show us that they can deliver a strong holiday quarter without costs getting out of control, as often happens at this time of the year for them. Hopefully, they won't let us down afterwards with a weak 2025 forecast. That's not in my forecast. Let me give you the bottom line. If UPS can keep growing volumes, expanding margins, and in general doing what they say they're going to do, then Wall Street will fall in love again with the stock because management's 2026 targets are incredibly bullish. You also get the yield, by the way. They just need to keep giving us more reasons to believe they can make the numbers. You know, after yesterday, I think this one's worth betting on. Mad Money's back after the break.
Coming up, is the post-earnings pop in Deckers Outdoor enough to keep this footwear company running higher? Cramer's digging into the details next.
Even though the footwear and apparel space has been challenged for a while now, I've repeatedly told you to buy Deckers Outdoor, which owns a terrific house of brands. We're talking about Uggs, Tevas, and then one of the best stories in footwear, Hoka. I've recommended Deckers at every turn, largely because Hoka's been taking share and taking names in the sneaker space, especially from Nike. So I wasn't particularly surprised to see that Deckers was the second best performer in the S&P 500 today, climbing $16 or more than 10% in response to last night's phenomenal quarter. In fact, the only thing that shocks me here is the fact that anyone was actually surprised by these great numbers at all. Let me give you some context. With last night's results, Deckers has now beaten earnings expectations for 12 consecutive quarters. And honestly, calling these beats is an understatement. Lately, they've destroyed the earnings estimates. In the last 4 quarters leading up to the one we got last night, that is amazing. Deckers have beaten expectations by an average of 45. That's right, 45%. They just keep crushing it. And hardly any of the analysts seem to adjust. That's why the stock's been able to rally 153% since the end of 2022, including a 51% gain year to date. However, if you zoom in on the chart, you can see that the entirety of this year's gains came during the first 5 months of 2024. Over the last 5 months, the stock has been under, let's say, a lot of pressure, at least until today. Not doing all the big gains. You can see it's been a little erratic. But let me see why. Let me tell you why. At first, you could chalk the pullback up to simple profit taking. Deckers saw its shares climb over 14% in a single day back in May after a blowout quarter. But they were building concerns about the health of the consumer. And the stock had run up dramatically, so a lot of shareholders decided, you know what, let's just ring the register. Nothing wrong with that. In late July, Deckers delivered another terrific quarter. But shortly after that, this yen carry trade, remember that thing imploded and the whole stock market got slammed, erasing the gains there. Over the course of August and September, the stock did manage to grind higher from around 140 in early August to the low 160s earlier this month. Earlier this week, though, we saw something really strange. On Tuesday, just 2 days before the quarter, analysts at a brokerage firm called BTIG downgraded Deckers, downgraded it from buy to neutral because, in the analyst's words, quote, signs of moderating growth put multiple at risk. And here we're speaking about the price to earnings multiple. Now, to be fair to the BTIG analysts, this was hardly a devastating downgrade. They were basically making a valuation call because Deckers had been such a long-term winner. But that downgrade sent the stock down 5.7% over the course of Tuesday and Wednesday. It was frightening. Frankly, it spooked me a bit, too. The analysts talked about less buzz for Uggs heading into the holidays. That worried me. There's always a lot of buzz. Possible share loss for Hoka in the running shoe category. They've been taking share. They argued that with the stock trading at a big premium to its historical valuation, Deckers was vulnerable. From BTIG's perspective, the risk-reward just wasn't as good as it used to be. Now, I thought they might actually know something. I don't, and the short sellers did too. But when Deckers reported last night, they shot the lights out yet. Again, magnificent beat and raise quarter. Company put up a sizable revenue beat, 20.1% growth. BTIG was worried about moderating growth, but that number merely is down from 22.1 in the prior quarter. I guess that's moderating. I'll take that modulation. And Deckers only grew at an 18.2% clip in the 2024 fiscal year. The analysts collectively are only looking for 10.3% growth. They got this one dead wrong. All their named brand segments beat expectations, with only the catch-all other brands, which it's a small line item falling short. BTIG was worried about Uggs and Hoka, but Uggs grew 13% and Hoka was up an astounding 34.7%. In fact, Hoka did $571 million in sales. Wall Street was only looking for $521. Forget moderating growth for Hoka. This brand's accelerating. They make some of the hottest shoes out there. Of course, their sales are on fire, and David Faber wore them today, which is an apropos of absolutely nothing. Below the top line, Deckers' gross margin came in at 55.9. That's a market improvement from 53.4 the year before, and far better than the 52% Wall Street was looking for. And we got yet another huge earnings beat. Deckers earned $1.59 per share, up 39.5% year over year, when the analysts were looking for $1.24. Now, that is a monster beat. I don't know many that have had that kind of number. Management also raised their forecast for the 2025 fiscal year, which ends next March. They're talking about 12% revenue growth, up from the 10% they predicted yet previously. Nice boost there, right? They also boosted their margin guidance. And when you account for the recent 6-for-1, I wish they hadn't done a 6-for-1. I was talking to Ben Soto, who's the researcher. We wish they'd done a 5-for-1. Because it's just easier in your mind. But the 6-for-1, before they did that, they also took up their earnings per share forecast substantially. Now, even some of these new higher targets are still a little bit below Wall Street's consensus estimates, but nobody cared because Deckers has an incredible track record of practicing UPOD. And UPOD, as you might know, is under promise and over deliver. I'm just amazed that so many people thought this quarter would be bad, even though Deckers keeps knocking it out of the park. The conference call was led by the first time by the new CEO at Stefano Carati, and he's an industry veteran who held senior roles at Puma and Nike for taking the Deckers job last year. He told an excellent story of a business that is frankly firing on all cylinders. Hoka is still seeing excellent full-year price demand, which is a big part of why it can keep putting up accelerating growth and why the company has such great gross margins. Hoka's U.S. business was steady with balanced growth across direct-to-consumer and wholesale. The international business is on fire with strength in Europe and Asia, and a very encouraging sign, international direct-to-consumer sales are growing faster than international wholesale sales. Deckers makes more money when they can sell direct. People may not want to order Nikes online. You know, I told you when it's $200, they don't want to do that DTC stuff. But it doesn't seem to be a problem for Hoka. Now, Karate also sounds very happy with UGG's performance, saying, literally, I'm going to quote, "I could not be more pleased with the UGG brand's year-to-date results," end quote. They used to primarily be a winter brand, but they've made so much progress that it's now a strong year-round brand. In the end, we got another rock-solid beat and raise quarter from Deckers, one of my favorite companies in the entire consumer space, and that, by the way, dates back to 2012. I just hope you didn't get scared away by that, well, let's just say that profit-taking BTIG downgrade. I'm being very generous there. Bottom line, from where I sit, this story is as fresh as ever. After today's run to 168, I think Deckers can keep charging to its July all-time high of 184 and change, up another 10% from here. After that, you know what? Who knows? I can tell you this, though. I'll only stop being bullish on Deckers when the company gives me a reason to stop being bullish. And so far, that hasn't happened.
All aboard!
House of Pleasure.
Chuck in North Carolina. Chuck?
Yes, Jim. Thank you. Booyah. Thanks for taking my call once again.
Thank you for calling in, Chuck. How can I help you this Friday?
Yes, sir. Following up on a call in June, I spoke with you. Your opinion was to hold Chipotle and wait as the price had run up a great deal. This is a small position in our portfolio. What is your opinion on acquiring additional shares, or would you hold on to them?
Okay, I was doing some work on it because they do report next week. Of course, I'm a big Brian Nickel guy. But you know what? We had Scott Boatwright on, Jack Hartung staying another year. I see no reason why the momentum just can't continue. I want you to hold on to Chipotle through the quarter. Don't worry about it. Don't trade it on this number that comes out this week. Bob in California. Bob.
Hey, Jim. How you doing today?
I am doing very well, Bob, because we had such a good time with the staff. We had Regina Gilgan, Heather Gaines down there on that terrific platform in the Gulf, and we're all fired up. How can I help you?
That was great. It was a great show yesterday.
Oh, thank you very much.
I'm calling about a company I've held for the last 16 years, PKG, Packaging Corporation of America.
Really? Held it for that long? Wow.
Yes, I have. It's been very good to me, Jim. Very good to me, just like you've been very good to me.
Oh, thank you. Look, you have the best in the industry. What's rather amazing is that when this one came out, I remember because my dad was in the paper business, I didn't think it was going to be all that special. That was wrong. It's terrific. You've got a winner, and I thank you for saying those terrific words to us about what we do. All right, I'm only going to stop being bullish on Deckers when the company gives me a reason to stop being bullish. This was really a great quarter. The analysts didn't see it coming. So far, nothing but net when it comes to Deckers. Now, much more mad money ahead, including my sit down with another one I love called Tractor Supply. Is the post-earnings drop in the rural lifestyle retailer a buying opportunity? Or maybe it's something else for here. Maybe they've run out of space. I'll dig into it with the CEO. Then, is the block merger between Tapestry and Capri another example of government overreach? Or is it a win for the consumer? I'm sharing where I come out. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Okay, what do we make of these numbers from Tractor Supply? Long one of my favorites. Retailer focused on recreational farmers, ranchers, and gardeners. People like me, okay? Yesterday, Tractor Supply reported a set of mostly inline numbers, although the same-store sales were down 0.2%. Wall Street was looking for plus 0.2%. Still, management raised the midpoint of their full-year forecast for sales, same-store sales, and net income. But I guess that wasn't enough to please the traders. It fell 6% yesterday. I think that's mostly because the stock came in too hot. Going into the quarter, Tractor Supply was up 36% for the year. So could this be the buying opportunities or something truly wrong here? One of the hottest stories in retail. Let's check in with Hal Lawton. He's the president and CEO of Tractor Supply Company to find out. Mr. Lawton, welcome back to Mad Money.
Hey, Jim, how are you? Thanks for having me on today. Looks like you had a fun time yesterday.
Oh, thank you. Yeah, it was really great to be out there. The beauty of the platform of the Gulf of Mexico. I come back to one of my favorite stories, your company, Tractor Supply, and something that seems to have gone viral, which is I'm mesmerized by, the skeleton rooster. This must be a great Halloween season for Tractor Supply.
You know, Jim, Our customers love to participate in the holiday seasons like the rest of America does, but they love to do it in the way that's consistent with life out here. 20% of our customers raise chickens, and thus the 6-foot rooster that has made quite the viral sensation on TikTok this year.
In a period where we have so much division in the country, it is very strange, but I think this Halloween, you got to tell me, has become the national holiday for the second half of the year. National meaning that, look, everybody wants to celebrate.
You know, it's the second most spent on holiday in the season. It's the kickoff to fall in many ways. Yeah, I totally agree. I mean, customers love to get out. Consumers love to get out, enjoy the fall season. Tractor Supply is a great destination for them, whether it's for their Halloween and harvest decor, or whether it's for their daily needs, their animal feed and pet food, or whether they're getting ready for the fall season and just getting their yards and their home ready for the inevitable winter.
You have a great loyalty program. What brings people to the store? How much of it is animals? How much of it is decor? I know clothes is as big as I'd like it because you know clothes better than anybody. But what's getting people to come into Tractor Supply?
You know, Jim, our bread and butter is our animal feed and pet food. They are demand-driven, needs-based businesses that drive those footsteps into our stores every single day. We're the largest player in bagged animal feed in the country, somewhere between a 20 and a 25% share, depending on if you're talking about equine feed, livestock feed, or poultry feed. And then we're the number 5 player in pet as well. As you mentioned, we have a 37 million plus membership program called Neighbors Club. That is a highly engaged group that shops with us on a weekly and biweekly basis. And we just announced yesterday a deal, an acquisition that hopefully will close shortly, of a company called Allivet, which will be a great integration into our Neighbors Club program and bring more and more value to those members.
Well, people have to understand, we've long been using the vet at our Tractor Supply, that you have been associated with animal health for a long time. This really solidifies it, give you a much better deal. I think better the deal than I know I love the guys from Chewy, Hal, but I think you guys offer a competitive price.
Yeah, this is going to be a very good tuck-in acquisition for us. It is a best-in-class technology platform with a great management team, and they make money. You know, we're going to be able to combine that with our 37 million plus member Neighbors Club program. And, you know, 88% of our customers, Jim, have either a pet or an animal. And so it's just a great combination, a great mashup. We're looking forward to bringing affordable pet and animal health care to our customers.
Now, during the pandemic, you had a lot of people who had worked from home, and a lot of people had realized how great it is to have a strip of land and do something, whether it be just to build it. Look, I know a lot of people, literally a lot of people who decide to take in chickens. Then you have to build a pretty big thing to keep the fox away. But are those people coming back and abandoning the farm, or is that just here to stay?
It's here to stay, Jim. We've been a big participant or benefactor of the mobility out to rural America and the exurbs. It's really where the affordable homes, and with interest rates seeming to be higher for longer, it's inevitable that rural and exurban America are going to continue to be the mobility location of choice for millennials as they look to shop, and they want to live that life out here. You know, we're one of the few retailers whose transactions are well above their pre-COVID levels, and we're one of the few retailers that's had positive comps every year since COVID. And I think that speaks to the fact that, you know, we drove a lot of traffic and engagement into our stores, and we've been able to maintain that over the last 5 years.
No, that's a very remarkable figure, because we've all accepted that most are down 3, down 4, and we just hope they're not down 10, down 12. Now, Hal, I think you need to explain to people, and this is something I very quickly realized. I always loved my account at the local Feed and Grain. It was always great. I'd come in, they know me. But you know what? There's a lot of people who want price. And if you haven't been in a farm, if you just come to a farm, there is a completely different price at Tractor Supply than the typical Feed and Grain, isn't there?
You know, Jim, we have one of the most sophisticated supply chains in all of retail. It's purposeful built for our business. We moved 8.6 billion pounds of food and feed last year through our supply chain. That gives us significant cost advantage that we're able to pass along to our customers and make life more affordable for them. And so, you know, we're proud of the prices we're able to maintain on our feed, on our pet food, but also on things like fertilizer and grass seed, or in the wintertime, wood pellets and and propane. We are there for our customers on the demand-driven, needs-based products that they need, and no one provides a better price than we do on those products.
This week, will you switch to any Thanksgiving decor? People like to do their houses for Thanksgiving.
It's going to be a fast and furious holiday season. There's probably more unknowns and a wider range of outcomes this holiday than I've seen in my 25 years in retail. On the positive side, you've got an all-time high stock market, you've got a wealth effect, you've got a strong economy. But on the flip side, you've got obviously the federal election, which creates an element of anxiety and postponement of spend for customers just because of the distraction, if nothing else. And then this holiday season's 5 shorter days than last year. It's the shortest holiday selling season you can have between Thanksgiving and Christmas. So it's going to be a fun one, fast and furious.
All right, last question. What I'm looking at, we have a lot of really just big bag pet food. But you mentioned something that I keep hearing about. I want to go back to chickens. What is it about chickens that people have discovered? I tried them. Yes, the fox got in the hen house and they ripped the necks. One fox ripped everybody's neck. What is it about chickens that people are believing in, and how much do you need to get from Tractor Supply to make it so that the animals don't get to the chickens?
We think of chickens as almost like the third pet for our customers. 20%, as I mentioned earlier, of our customers raise chickens. And it really has to do with kind of that backyard enthusiast. They're building a garden, perhaps a raised bed garden. They're doing an area with their coop and fencing that in. They've got room for their dogs to run and play. They've got a grill. It's really all about that backyard enthusiast. And that's really when the millennial customers move out to ex-urban and rural America, that's what they want to create. And they're chickens, they name them, they become a part of their family. And to your point, we help our customers raise and care for those chickens, whether that's in protection type things with fencing and the coops, or certainly heaters in the winter, and obviously feed and watering and all those sorts of things you need to raise a healthy flock.
Necessities. Last question. The kinds of things we're talking about are not really seasonal. Can they overcome a short 5-day holiday season? In other words, destination Tractor Supply regardless of the season?
While holiday is important for us, and we certainly participate in gifting, in apparel, right, as you mentioned earlier, or whether it's in our tool sets and, a variety of other ways, decor. The thing that matters the most to us is supporting our customers day in, day out on the needs they have. And during the wintertime, that's wood pellets. We're the largest seller of wood pellets in the country. Propane, our customers rely on both of those for secondary heating. We sell fireplaces and heaters, and then all of the things you need, log splitters, et cetera. And that's really where the core of our business is. Insulated outerwear, all those Carhartt jackets and hoodies and such. That's really where the bulk of our business is during the holiday season. So we look forward to some cold weather here soon.
Well, all that stuff is a necessity. When you get a log splitter, people just understand. You don't have to go buy firewood. And when you buy Carhartt, you never have to go buy it again because the stuff lasts forever. I want to thank Hal Lawton, President and CEO of Tractor Supply, for coming on the show. And the skeleton rooster, brilliant. I don't know whether that was yours. Brilliant. Fantastic. Great to see you, Hal. Thank you. Mad Money's back here for break.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. Time for the labor. We're only changing the stock. I tell you about buy sells fair just be here. I don't know the core stock credit. My Stanford is the greatest. You plan to sell. And then the lightning round is over. Are you ready, Ski Daddy? Time for the lightning round. Okay, let's start with Tom in Minnesota. Tom.
Jim, good afternoon. I got a quick question on TSM. They've got a CDP score of a B with a PE ratio of 32 plus. They show a 52-week high of 212, and they're sitting at 203. Should I buy some of these?
The reason why that price earnings multiple is so high is because they blow away the numbers. Turns out it's actually a lower price earnings multiple. I think this company is the best in the business. They're terrific. They are partners with NVIDIA, and I think you should own it. Let's go to Jim in Florida. Jim.
Jimmy, a big Le Chateau, Naples, Florida. Booyah to you.
I'm liking that booyah.
My stock is NEP. You had warned me about the dividend.
I'm warning you about the dividend again. I mean, I think the dividend, when you get those yields 15, 20%, you know it is trouble. There will be people who don't know that it's trouble, and they will sell when they cut the dividend, and then we'll look at it. Let's go to Michael in Texas. Michael.
Hey, this is Michael from Texas. My stock is EVGO.
Stock's been on fire. People feel like that a Tesla EV and an EVGO are made in heaven, that people are going to go back to EV. I think it is a spec. It's losing money, and I think it's too high. Let's go to Angel in Florida. Angel.
Hey, Jim. I'm calling about Qualcomm. With all the latest news, is it still a buy? Is it a sell?
Well, people love Qualcomm. I can tell you that I think that they're overreaching, talking about buying Intel. I also think that they're on the wrong side of the trade in that lawsuit with ARM. I'm not a fan. Let's go to no one, because that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Regular viewers know that I'm no fan of the Biden administration's FTC. I think it has repeatedly overreached and become downright anti-business, especially when it comes to trying to rein in great American companies like Amazon, simply because they believe they're too powerful. To me, Amazon is a great equalizer, and Amazon Prime is a ridiculous bargain for consumers, which is why there are 200 million Prime members. The FTC thinks it knows better, which is why it's suing Amazon for illegally maintaining monopoly power, even though this company's done more than anyone to fight inflation at a time when Americans are feeling the pinch from high prices. But, it's a very big but, sometimes the FTC is right. Not long ago, the FTC sued to block the merger of two women's accessories companies, Tapestry, the parent of Coach and Kate Spade, and Capri, which owns Versace and Michael Kors. Most people in the arbitrage business stepped up to buy Capri and sell Tapestry because that's how the bet of a deal goes through, makes you money. They figured, who would block this deal? The answer, the FTC. Now, initially, I thought that this was still one more foolish effort by the Bureau of Overreach. I'll admit that. But as I became more familiar with the story, I saw that this merger could raise prices for a particular category. It's called the accessible/affordable luxury segment of the handbag business. Tapestry's Coach and Kate Spade are key players in this segment, as is Capri's Michael Kors. Yesterday, a federal court ruled in favor of the FTC, and that is a death sentence for the deal. It ain't going to happen. When I read the judge's analysis, it showed conclusively that this merger could raise the price of handbags in the category because Tapestry and Capri are pretty serious competitors in many stores, including Macy's, where Coach and Kors are neck and neck. Jeff Gannett, the former CEO of Macy's, testified in favor of the deal, arguing the prices would not increase. Court thought otherwise. I know some of you might wonder why the FTC would even waste their time on something as inconsequential as handbags. What's the problem here? There's so many different kinds, right? True, but if you judge it by the category, accessible, affordable, this is basically the top two dogs getting together, which gives them tremendous pricing power and scale. I may not like the agenda at the FTC, but in an inflation-ridden era, I think this particular case is smart. We want affordable luxury to be, well, affordable. And if something makes it less affordable, then you know what? They're right to block it. Why do I agree with the findings? Because if Tapestry takes out the competition, I figure it can raise prices at will. I don't know what will happen now. I mean, judging by today's collapse, this is why I said it's dead. Capri stock down 49%, soaring of Tapestry up 13%. Now, some of that's about the arbitrage guys unwinding the trades that I mentioned earlier. But the market's also saying that Tapestry shareholders are rejoicing now that they can get out of the deal, while Capri shareholders are very concerned about the business itself. Troubling. It's suddenly become a real pariah. Now, you might ask, why even bother caring about handbags at all, though? Aren't they discretionary? Can't you just do without them? Judge Jennifer Rochon dealt with that directly, saying, and I quote, downplaying the importance of handbags as non-essential discretionary items that consumers can simply choose not to buy if the price is too high ignores that handbags are important to many women, not only to express themselves through fashion, but to aid in their daily lives, from supporting their career aspirations by transporting their work materials home or inspiring confidence in professional settings, to holding important personal items such as medication or personal hygiene products, to carrying a young child's snacks or toys. At the end of the day, I really don't have to think about this stuff because men's clothes, well, we got pockets, but most women's clothes don't. So who the heck am I to disagree? I like to say, as always, bull market summary. I promise I'll fight just right. Mad money. I'm Jim Cramer. See you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.